So today I wanted to talk to you about the fact that not every financial tool that is offered to you is valuable, and we're going to talk about the fact that at the moment, from the articles I've been seeing, they are pushing a particular financial tool out there and it may not be in your best interests. First of all, thank you for watching. I do this particular show I call Dollar is Dead to help people get out of debt, talk about the economy, talk about interest rates, and discuss how you can create and preserve your wealth. If you appreciate the time I put into this, please hit that like button and do leave a comment, just a thank you, or I like your format, or I don't like your format, or maybe suggestions of things you'd like to see in the future. And if you could share it, I'd appreciate that as well. I'm trying to grow this to at least 10,000 people. We're almost at 5,000 over a pretty quick period of time. And I'm hoping that that means that we're getting out to 10,000 people to help them also get out of debt and take control of their financial future. If you've been watching me, you know that I always say the government doesn't care about you, banks don't care about you. You have to take control of your financial future. And if you do, financial freedom is true freedom. Now, what am I talking about? In my opinion, and this show is never financial advice, I always have to say that, but in my opinion, every financial tool or instrument available to you is a double-edged sword. You can use it to your advantage, you can use it to your disadvantage. It can help you or it can hurt you. And no matter what it is that we're talking about, I'll give some examples, you'll always be able to find someone who says, well, some people take this and they use it in this manner, and that's terrible for them. For example, credit cards. One way to use credit cards is to use your card during the month for the bills and things that you have the money to pay for. So instead of taking the money out of your checking account with a debit card, you use the credit card. And then at the end of the month, before the statement rolls over, before you owe any interest, you pay off the credit card. In that case, you would be getting, let's say, miles or points or free cash off of the credit card. You're building your credit, that sort of thing. That's a positive way of using it. Using it to buy superfluous stuff that you don't need and spending more than you make on a monthly basis, putting yourself further into debt, that's a bad way of using it. Same thing with personal loans and any other financial instrument. I'm going to talk about in particular HELOCs, home equity line of credit. If you're familiar with basically any type of loan, it's easy to get loans, or I should say easier, if there's collateral. For example, you want to get a car loan. The collateral is the car. If you don't pay the loan, they back up a truck, they hook it up, and they tow it away. They take the car. Same with a house. The collateral is the house. Some personal loans have collateral, some do not. If they don't have collateral, then there's nothing they can take from you. They're just saying, well, we hope you're going to pay this back, and they look into your financial past and your relationship with them, etc. Okay. So I'm bringing this up because what I've been reading and seeing is that they're pushing HELOCs, or it looks like they're going to start pushing HELOCs and making them easier to obtain. And they're not doing it to help you out. Let me explain. The economy, from various sources, doesn't look like it's doing so well. Inflation's going up, unemployment's going up, and GDP, what the nation produces, products and services, is going down. Those are three things we don't want to be happening, particularly at the same time. Now, the economy overall is primarily driven by consumers, by you and I going out there and buying things and putting money into the economy. So, this being an election year, they obviously want the economy to look like it's doing well. How do you do that? Well, you have people spending money. One way to have people spend money is to have a fantastic economy. Things are going great. Unemployment is low. People have jobs. People have decent wages. Therefore, they have extra money to spend and they put that into the economy. Everyone's benefiting and it looks great. But if people don't have jobs and they don't have money, then where are they going to get the money to put into the economy? Well, they might be driving themselves into debt with things like credit cards. That not only is the amount of money being put on credit cards going up, but delinquency rates are going up. People aren't able to even pay for them. So what has happened recently, as you very well know, is homes are unaffordable. If you base it on how much someone makes and you look at the home affordability index, it's substantially more than a person's average salary, and homes are more unaffordable than they've ever been. And the end result is essentially that home prices are much higher, at least they've been appraised higher. Whether or not people can sell them for what they believe to be these higher prices now, who knows? You're only going to get for your house what someone really pays for. But with higher assessed values, the government is very happy because they're charging you taxes on that higher value. It also means that theoretically you have equity in the home if they're being appraised at a high amount. So the government canceled student loans, put money in people's bank accounts. That money was spent, or it was money that they didn't have to pay back, so now they had it to spend. So the government's looking for more places so that you can get your hands on more money and push it back into the economy. And it looks like, from what I've read, they're going to try to make HELOCs easier to obtain, meaning maybe the credit scores don't have to be as great, or the government says they will back them up so that if something goes wrong, they'll cover it. Whatever it may be, they'll be pulling some kind of shenanigans with Freddie and Fannie and whatnot. But why are they doing that? Well, again, double-edged sword. If you were to take a home equity line of credit, which means the equity in your home, you're able to get a loan. You're going to pay that over a long period of time. It typically has a lower interest rate than something like a credit card or even a personal loan. So if you're using it in the good manner, you might consolidate and pay off some credit cards and pay it off with a home equity line of credit. Maybe the home equity line of credit is, 6%, 8%, 10%, 12%. It beats 24% on a credit card or 30%. So you're obviously taking, and I'm pointing this out, but it's obvious, you're taking that 20 or 30% debt and you're moving it on to a lower, cheaper debt. That's a good way of using that home equity line of credit. Assuming you've got everything else in order, you're not spending more than you make, you've got your budget under control, and you have a plan to pay off that HELOC as fast as you can. Okay, a bad way of using it, and that's what they seem to want you to do at the moment, is go out, get a home equity line of credit, and then go buy things. Go on vacation, go purchase new clothes, things you may or may not need, go purchase gifts, you name it. So they want to make it easier for people to get their hands on that money, turn around and pump it back into the economy. That's not helping anyone. It's going to mean that you're going to end up having more debt if you don't have a plan to pay that back, or if you're unable to pay that back. So be careful. What I wanted to point out today is that every financial instrument is a double-edged sword, and be careful what you see. Just because you're being offered something like a HELOC at a great rate, make sure that you are able to put handcuffs on yourself and only use it for good and don't use it for bad. It doesn't look like the economy is doing well. It doesn't look like it's going to turn around anytime soon. And the last thing you want to do is find yourself out of work with even more debt than you had a while ago. I've got videos on how to create your emergency funds, how to make them last, how to cut your expenses so your emergency funds can last longer. Take a look at those. Thank you for watching. Please subscribe if you find this to be helpful. Hit that like button, and if you would share it with others, I think that would be great, because I put this show on 3 times a week just to talk about the economy, getting out of debt, that sort of thing, and then I have instructional videos, as many as I can do, to try to help people out. Thanks. Have a great day. And remember, only use financial instruments for your benefit, not your detriment. Take care.